How does quantitative tightening impact inflation and the economy? Imagine a central bank trying to keep prices steady while also making sure the economy doesn't overheat. That's where quantitative tightening comes into play. It's a tool used to slow down the economy when inflation starts to rise too quickly. Quantitative tightening involves the central bank shrinking its balance sheet. It does this by selling government bonds or letting bonds mature without reinvesting the proceeds. When the central bank sells bonds, it pulls money out of the financial system. This reduces the amount of cash banks have available to lend. With less money circulating, interest rates tend to go up. Higher interest rates make borrowing more expensive for everyone. People might think twice about taking out a mortgage or a car loan. Businesses may delay or reduce investments because financing costs are higher. This slowdown in borrowing and spending helps to ease inflation. When demand drops, prices tend to stabilize or grow more slowly. On a broader level, quantitative tightening can slow economic growth. As loans become more costly, consumers and companies spend less. This can lead to fewer jobs and lower profits for businesses. If the process is too quick or too aggressive, it might even cause a recession. That's why central banks aim to implement QT carefully, balancing inflation control with economic health. Financial markets also feel the impact. When the central bank sells bonds, bond prices usually fall and yields rise. Rising yields can make stocks less attractive, which might cause stock prices to drop. Additionally, higher interest rates often strengthen the national currency. This can make exports more expensive for foreign buyers, potentially reducing export sales. Central banks use quantitative tightening after periods of quantitative easing, which is when they buy bonds to stimulate the economy. The goal of QT is to gradually return the money supply to more normal levels. It's a way to prevent inflation from spiraling out of control without causing too much harm to economic growth. In simple terms, quantitative tightening reduces the money supply, leading to higher interest rates. This makes borrowing more costly, which slows demand and helps bring inflation down. It also influences financial markets and exchange rates, making it a powerful tool for managing the economy's health.